So we have another panel now. We've got some excellent investors and analysts and mine finance professionals. So I'd like to welcome to the stage Robert Bayliss from Roskill, Aline Carnizelo from Parler, Kwasi Ampofo from Bloomberg New Energy Finance, Simon Gardner-Bond from TechMet, and Will Smith from Westbeck Capital. So while everyone's joining me here, I'd just like to say, yeah, very, very intrigued to be examining battery raw materials supply chain and getting some insight here on exactly where we are and where the investment opportunities might lie. So if you have any questions, stick your hand up throughout, and we'll try and put these to the panel as we go. So thanks for joining me, everyone. I'd like to perhaps start and get quickly into the buy-side view of this EVs narrative that's been driving for quite some time now, investment theses into battery raw materials, if we can group it as that. Perhaps, Aline, I could start with you. And maybe also, could you tell us a little bit about Parler, the funds that you look at after as well within that?
Yeah. So Parler Investments, we have about 3 funds. One is fixed income and convertibles focus. The other fund, we call it PE, but it's really non-liquid stakes in what could be tradable companies, such as our stake in Nevada Copper at the moment. And the third part is where I'm mostly involved in is a hedge fund where we have liquid strategies and we trade commodity equities and also fixed income. We are quite invested in the EV space. We have started our thematic understanding back in 2014, started our stockpiles of strategic metals in 2015, and from there we are investing in the supply chain of this thematic and considering even now spinning off to what would be an EV thematic fund only, which would be a 4th fund potentially coming up.
Okay. And within that thematic you discussed, what are some of the key drivers or the key themes, or perhaps how have you seen it evolve since you set that up originally?
Yeah, so when we started in 2015, back then, we are like one of the only ones looking into this thematic. We are really, no one was a believer, and we are saying we believe in these electric vehicles. We are keen to buy this Cobalt at $9. And everybody, people were not there at the moment. And what we really believe it was this, what we just see now, a hockey stick growth in electric vehicles. I think the key is that it is a lot of work to understand, the supply and the demand dynamics, and as well balancing the EV thematic with the normal demand side and supply side of each commodity, because EV is just one of the components of these materials. So what we do is really in-depth work, both from a macro perspective and a micro perspective. And I think what really gives us an edge is the fact that we also have like a mining-focused team that can, also on a micro perspective help us pick the best assets. So I think that's where we differentiate across the space.
And you're working very closely with that team.
Yes, so we work extremely close to the technical team who help us pick assets that will better perform and will be performing at the levels where we see prices for those commodities.
Excellent. Will, tell us about your fund and when it was established and your focus now.
Yeah, Westbeck was founded in 2015. We launched our first fund there, which was an energy fund, mainly focused on oil and gas, but we do have 15% in the lithium space at the moment. We're very cognizant of the fact that carbon-heavy companies are being derated. We play a lot in the commodity. The energy equities are a relatively difficult space now with the rise in ESG investing and the consequent derating of the energy companies. We're launching our second fund in July, the Westbeck Volta Fund, which is going to be based on those companies supplying the materials required for the energy transition. Obviously, there'll be a lot of producers there of the various metals, but we're also going to go into the specialty chemical companies, battery manufacturers, the companies that are really going to benefit from this change. Since 2011, the peak of the market, there's been a slowdown in investing in the mining companies. Right now, we see the metals markets relatively tight. What we do see is this wave of demand coming through over the next 10, 15 years, which we think is going to unbalance the market somewhat. And so we're putting this fund together to benefit from that.
And the fund is across the supply chain?
Yeah, absolutely.
How much weighted into the mining? Or
Absolutely across the supply chain. There will be from the miners that actually produce the raw materials to those that beneficiate, and then the specialty chemical companies who turn it into the products that the battery manufacturers.
Yep.
So we're going to go absolutely across the value chain.
And you mentioned producers. Would you be looking at earlier stage projects within that?
I think if our demand forecasts are right, then the production capacity has to grow. Yep. The existing capacity for nickel, for lithium, for copper, we're going to have to increase that over the next 10, 15 years. And that will require equity investment at some stage. Certainly back in 2017 now, it was a tough year for oil companies, and the fund performance was greatly benefited by our investments into the lithium space. Yep. Early stage equity, it's not going to be a small cap mining fund, if you will, but we certainly have to be aware of new projects coming on.
Yep. Excellent. Simon, tell us about TechMet and what are you up to there? You've got a very unique...
Hi. So TechMet is a private company, and we're deploying capital into into assets that are supplying the material supply chain for the electrification of the world. So electric vehicles, renewable energy storage. And we've got 5 projects at the moment which we're deploying capital into, and we'll be looking for more and expansion from there. But I thought I'd answer your question a bit from what you said about the fact that there's been a focus on investment in this sector. I think actually the problem with the sector at the moment, this little subsector of battery metals, technology metals, is that's actually not the case. You know, there's still, and there has been, and we'll touch on it there, that there is a severe lack of investment, a lack of interest in the sector at the moment, and there's 2 things that can point to that directly. One is that the last 12 months have seen a number of failures of IPOs and capital raisings for projects in this space. And it's essentially because you need the generalist investors on board. Aline's very lucky. She's got a good team, good pool of capital, which is willing to go into quite a specialist sector, so she can look quite long dated. The only real other people that are doing that are the Chinese. You know, they've got a huge pool of capital and they're willing to look long term, so they've gone in and they dominate. Unfortunately, the way that our system works in the West is that we invariably need to list, and we need to be on the public markets. And as Will said, at the end of the day, a lot of it is mining, and people have been burnt by mining, and they're just not willing to invest.
Yep.
So, I mean, for us, I'm quite happy with that because we're a private company, and that's an opportunity for us. But for everyone else out there, listed companies, it is a real problem. I think we live in a little bubble of the mining universe where we think, you know, we see battery metal articles all the time because we like that in our newsfeed, but it's not the case across the wider investment community.
Yep.
And it needs to be because the story is compelling.
Yeah, indeed. So, well, Ian Williams was saying on the gold panel this morning about the sort of the demand side of around EVs and battery raw materials, and how he believed that might be the catalyst to kick generalist capital back into mining in general, and as a proxy filter into gold. That's a separate argument, but the point is he saw or believed that this narrative would bring generalist capital back in. So you're not seeing it nearly the level sufficient.
It's not that I'm not seeing it, it's that it's not happening. You know, I can tell you failed IPOs. I've worked on some, unfortunately, but and there are capital raisings. Bacanora, you know, I'm sorry to pick one company, I don't particularly want to do that, but it's just, you know, taking an investment for a whacking great stake in the company for a very low valuation. You know, and that's something that I'm willing to bet every supply, you know, every analyst, I'm looking at you, every analyst has got in their supply line going forward. Well, if I take a step back from that, I can say I'm pretty sure it's not going to happen for a while.
What do you think is needed? It's the condition of mining overall that's causing this, and what do you think is maybe needed to make it attractive again then? And could the battery metals sector be the one that leads that way?
It's probably going to need more larger private patient capital, but there's probably going to have to be a shock. It annoys me because I've been working in metals and mining for 15 years, and I see this cycle after cycle, and it's just frustrating. But you are probably going to need to see a shock for the generalist investor to say, oh yes, that is a sector I can make a decent return from for that level of risk.
Yeah.
And then they'll come piling in, and then there'll be a boom and a bust, and it'll be the same again.
Yeah, I completely agree with that. I think on the generalist side, the difficulty is that, electrification and the EV metals are very interesting, compelling story for us. I think completely agree we get this bias because we're so obsessed about it. By we, I say me. Completely obsessed and love this thematic. That the truth is why Trump and Xi doesn't hug, and there are trade wars out there, and people are worried about global growth and inflation is low. Will be tough for generalist investors to come and buy copper. That is just a fact, because they're afraid of the macro picture that still dominates the majority of the demand for these metals in large places. So I think what we've seen is not the generalist interest, but a specific family office type of money looking into this thematic. We've seen some VC funds considering going to the mining side as well. And we've seen some specific ESG money also interesting to this thematic on the mining side. But the difficulty and the challenge in this type of money is the ESG risk that involves mining. They're very uncomfortable with it, the political risk, the overall community management risk and the environmental side. So they do need very strong backers to make sure that there won't be a problem in there. And it doesn't help that big mining companies not naming are having issues within those ESG topics. So I do think it brings an additional edge, but we are on a macro environment that we have to recognize that our risk is on the table, and mining is a risk-leveraged sector. So I think I agree with that. Okay. But it creates opportunities for specialist money that understands the dynamics behind the noise. So I think it is for us, I agree, for Opala it's better this way because we wouldn't get the projects and the valuations that we are currently getting for the upside that we are currently getting if the macro money was there. So you have to come before the macro money come. By the time they are here, it's already too late, I think.
Kwasi, I'd like to bring you in. What's your take on this as well, from the perspective from Bloomberg New Energy Finance? The capital is not being deployed, but the demand story seems to be there.
Yeah, so thank you very much. And then, so from Bloomberg New Energy Finance, Bloomberg NEF for short. So basically, what we're saying at Bloomberg NEF is a very huge surge in demand, like the other said, and I totally agree with that. And if I can point some numbers there, if you take demand from lithium-ion batteries alone, take cobalt, we're forecasting by 2025 that is going to grow 3 times the demand from lithium batteries alone. You take lithium, you're looking at 6 times what it is now. You take nickel, and it jumps off to 9 times what it is now. So there's a confident story on the side of the demand. And even if you look at the EV, so last week we just launched an interesting report on the electric vehicle outlook. And you look at by 2040, about 57% of cars that will be sold will come from EVs. And the fact that 500 million cars in the global fleet will be electric vehicles. So what does that tell us? It tells us that the demand story is strong, and certainly there's going to be a growth in there. But then if you look at the supply side, I mean, that's where you find a very big mismatch between the opportunity that is being presented and the value that is being gained from the supply side. So what we're trying to do is to try to assess, what is it? So first of all, we identified confidence as a key factor. The confidence in this sector is very low. Generally, if you take the mining industry, you have the 10-year boom-bust cycle, when you take a commodity like lithium, it comes down to about 3 to 5 years. It's so emotional because it's so not mature yet. So you have the confidence issue. We all know it's a great boom story. But then if you look at the confidence, and secondly, what do investors want? Return on capital, fundamental, basic. Is the number one question every investor asks before he puts money into anything. Am I going to get return on my capital? And you look around these days, artificial intelligence, the Uber, so you are competing for cash in a space where there are various other factors that seem to have the positives written all over it. So I think it's just that story being told in terms of, first of all, inspiring confidence in the sector, and secondly, being able to project that yes, there's demand coming online, we have supply, and we believe that we can return capital to investors. So I think those are the two main things that could be the game changer for supply.
Yep. Robert, I'd like to bring you in. What are your thoughts on that?
Well, I think Simon made a very good point about the capital that is coming into the sector and the challenges that companies face. I mean, I think across, particularly in lithium, you've seen a number of M&A deals. I think that probably seems attractive for some companies that don't want to go through to being an operator. And those operating challenges are pretty significant, and it's why companies like Bacanora and Namaska have really had trouble trying to finance their projects, because when you get to that stage, it's a different pool of money. It's generally more risk averse. And these projects are quite risky from a technical perspective. We still seem to see money coming into the sector to drive projects forward. Certainly, I think that the pipeline continues to grow, so that we don't see as being particularly problematic at the moment. And I think probably those investors that are buying into those companies are more believing of the long-term future of the industry, as was mentioned, rather than sort of any sort of short-term. Quite interestingly, I think you can definitely correlate the market to the prices. So we've seen the price go through a particularly boom period for lithium and for cobalt. That has definitely driven investment. It's driven project development as well. It's driven supply. And I think probably for some of the other sectors that need that, in particular, I would say probably nickel as the one, and also graphite, maybe the next ones to experience that sort of wave. I don't think it's really avoidable, particularly when you look at the incentive pricing needed to drive some of these projects. Even for the big ones, even in lithium, it looks like a high margin business. But when you crunch the numbers, you need a particularly high price to really generate project value. And I think as the prices have come down, that's probably put some companies off from investing. So I believe in the long-term demand story is definitely strong. It's just how you sort of best position yourself to sort of ride through that, and how you think about where you want to end up. Do you want to end up as an acquisition target? In which case you need a good, secure investment and a good project that attracts an incumbent producer. Or do you want to be an operating company, in which case you've got to chase low-cost, competitive type business. And those are the projects that I think probably are the ones that are going to stand out.
Can I pick up something Robert said there, and Kwasi said that you were talking about the bump in the prices. For me, that's been the biggest problem for the sector at the moment, because you said that encouraged some investment. There's a very small part of the market that likes that and goes and follows that, and it's generally uneducated retail. And, I'm broad brushing there, but it's pretty much true. The sizable money, that turns them off completely. You've got, what was your forecast for lithium growth in?
6 times from...
You've got the market-leading expert telling you that demand needs to grow by 6 times, or is going to grow by 6 times by 2030, and yet you still can't finance the 2 best new projects out there. At best, whatever, the 2 most nearest term projects out there. I don't want to give an opinion on them. But if that was someone selling, something on the high street, if that was people with rental bikes, or a new technology or a new drug or something, and the market leader said demand is going to increase by 6 times by 2030, there's no way that wouldn't be financed. So there is an inherent problem with this, and it's generally back to mining, and it's the volatility of the price. Again, there's an opportunity there for people like us, but it is a big problem.
Just to follow up on that, we look back at over history to find an example of a metal growing production over a 10-year period. And the greatest example we could find was copper production between 2000 and 2010, which grew at an average compound annual growth of 9%. Now, looking at some of the demand forecasts that we have out there, there's going to have to be a sea change in financing, in these companies getting into production, which at the moment just isn't out there. The demand forecasts that are there for copper, nickel, lithium, graphite, et cetera, are so big, and there's no history of any mining, of any metal growing that production accordingly. So I think it's going to be quite exciting.
And the problem with using that is that the metals we're talking about are a fraction of the size. So copper's, that was a great growth, but nickel's a tenth of the size of the copper market. Cobalt was a tenth of the size of the nickel market. So you're talking about, with copper, there are quite a few levers you could pull because so much money's been put into exploration over the last 100 years, really. But with these other elements, and then you get down to stuff like rare earths and things that there's nothing out there. So I have one of the problems I have with the data providers at the moment with Roskill and you guys is that you have this crocodile of supply-demand permanently, and it's just a fallacy. It's not going to happen. So I keep asking the data providers and the analysts like you two, so I'll ask you now, which is more likely to be wrong? Are you more likely to be wrong on your EV demand, or are you more likely to be wrong on your supply? Because you are going to be wrong on one, because they are going to balance, right?
I mean, I don't think it's a hard and fast rule that we'll be wrong on.
No, balancing is hard and fast. So
I
if
know.
you get to the end of any period, there is going to be a balance. So you constantly have these charts out there. It's very promotional. It's great. It's trying to get people interested, but it's not going to happen. So which is more likely to be wrong?
Well, I think, if you look at our models at Bloomberg, and one interesting thing is the fact that, so there's optimism about EV, okay? But then whenever we're looking at these demand forecasts, one thing we bear in mind, and it's not just a linear relationship, okay? Some way, somehow, I mean, look at China. Last year, they just took out the subsidies, and suddenly you have a drop in the number of EVs sold. The technology is not mature. Take stationary storage, for instance. Last year or 2 years ago, there have been about 22 fires in Korea in terms of storage. So we're trying to price all these things in our model to be as realistic as possible. You understand? But then as to which of them would get wrong, we try to be very reflective of what.
Come on, pick one.
Unfortunately,
I'm
quite confident.
Which is the least confident then?
No, I mean, I think I'm quite confident.
On both, but you can't be.
But then the point is that, so take supply, for instance, all right. We're trying to look at current production, and we're just trying to see what could come online over the next 5 years, over the next 20 years, over the next 30 years. And then we pick each project, and we try to de-risk it based on, take for example, capital, based on their geography, based on their off-take agreement, and we're trying to de-risk it. So that's what I'm saying, like, we're trying to put as much confidence as we can by looking at each individual case and de-risking it just to reflect what we believe is. So the problem is that we say over the next 5 years there's going to be 500,000 tons of, say, nickel onto the market. But then as to whether this will come in 2024, as to whether it will come on stream in 2022, as to whether it will come tomorrow or next year, that's the hard bit to tell. But then when we take a longer-term outlook, say over the next 7 years, we do believe that from optimization from mine A, from whatever activity in mine B, we have a strong opinion or we have a strong view that we believe A, B, C tons can come on stream. So it's a hard call, but then we are pretty confident, believe me.
Yeah, I think it's hard to directly answer the question, isn't it? But I think perhaps the difference is that with the demand growth forecast, which has always actually exceeded expectation, that's likely to be a smoother curve. I think with the sort of supply side, it's going to be more like a snake within the crocodile's jaws. So I think you're going to see supply go up and supply go down, and that will be clearly based on price. But certainly across most of the markets we look at, there's always a reaction. So if there's a small imbalance, price goes up, more supply appears. I mean, you've seen it over history. Something like nickel, NPI came into the markets, really drove forward Chinese stainless steel production and demand. And so that the market will find a way to find that supply. It may not be cheap, it may not be clean, but it'll appear. And I think one of the issues that the industry faces is that there's not enough joined up thinking. So these sort of questions aren't being asked really amongst the industry, or at least are being answered fast enough to know that that kind of security is going to be there in the future. So everyone's well on their path for their electrification goals, but whether they really have any joined up thinking about how that will be met by raw materials, I'm not sure. So if you were going to say anything, I think the raw material will be the main issue. I don't expect it to be a long-term deficit, but certainly there'll be short-term deficits within that, and that will certainly drive price to incentivize more production, as we frequently see in the cycle.
Yeah, if I was to look at the form book, I would tell you that the supply would disappoint, as it has done consistently. It will require different prices for supply to substantially grow. And we're just not, at today's prices, that isn't going to happen.
We've got a question down here to keep this part of the conversation going.
Yeah, I just wanted to throw something back at Simon. I mean, I think that everything you guys have said for the next 5 or 6 years is probably correct. But the one thing, when you go beyond that timeline, that you're leaving out is the chance of a new technology challenging lithium-ion batteries. And there's a lot of work going into ultra-capacitors at the moment. That's much more effective supercapacitors, which at the moment don't have the energy density necessary to be a true competitor. But I've seen 1 or 2 companies making big strides in that area, using a sort of polymer-based technology where actually, funnily enough, there'll be a lot of copper used to still hook these things in, but not so much lithium or nickel or cobalt. And so, I agree with what you're saying, looking forward to, say, 5 years, 2024, but looking forward to 2030 or so, there could be a new technology coming in there which derails a number of these forecasts. And I do think the ultra-capacitor area is something which has got to grow because of some inherent problems with lithium-ion batteries. And I don't think lithium-ion will necessarily be the dominant technology for EVs once we get to the 2030s.
Okay, yeah, I mean, I can answer that. We follow all new technologies, and a technological leap is definitely an issue. What I think, where I disagree with your outlook is there's a couple of things, really. Investment horizon and the time for commerciality of any new technology. So if you, much like mining, where there's a development cycle that's sort of 10 years, with any new technology to be able to get to a commercial stage, even for a successful developmental stage, there's going to be another decade before it comes into commercial use. So for my investment horizon, for the Gardner-Bond family, we're looking okay, because I think by 2030, I think the story we're looking at now is still going to be dominant. There's $300 billion being invested in the EV space by the OEMs, and then there's countless other billions by states and governments around the world and other companies as well. That is going to play out. History is littered with technologies that weren't the best but were the dominant. And sometimes they died out and sometimes they carried on through various other reasons. So I agree with you, it's not ideal. I've always thought that the lithium-ion batteries, it took me a while to get on board for lithium batteries, I must say, because from a technical point of view, it isn't the best, but it's okay at everything. It's safe enough, it's cheap enough, it's available enough, it's good enough in terms of performance, and it's getting better. But now there is so much capital going into it that the places where it's been failing, infrastructure, charge times, performance of the batteries themselves, they will improve because there has been so much latent capital that's already been invested in the lithium-ion space. So supercapacitors, yeah, they will play a part. You could talk the same game about hydrogen fuel cells. There's the mobility transformation, if we're talking about EV batteries, is going to be made up of many parts. But I do believe that lithium-ion will be the dominant for at least 20 years, and definitely my investment horizon, and probably most people's in the room.
I completely agree. I think the market is completely underpricing the de-risk that we just seen in the lithium battery space. When we started looking at this thematic, there were very little implementation from the OEM. Now you're seeing doubling the electric vehicles announced. That means that those vehicles are designed, the production lines are being put in place, and everything is mostly financed for the BNOV estimates. The amount of de-risk on this technology is very high. To change this to get to where we are now would be, yes, you can have competing technologies, but the thing is, lithium is already on scale to ramp up. So I agree that by 2030 will be hard to see something else coming. Maybe solid-state batteries would be the one that we need to watch, but these investments are in place now, so it de-risked tremendously the demand forecast, in my opinion.
Yeah, I totally agree. And one of the few areas that we are, whenever we model, we sort of add, quote-unquote, a caution notice when we're looking at batteries. So beyond 2025, we become a bit more cautious with how we project the lithium-ion battery.
I agree with you.
Yeah, and so 2025 is our switch point where we believe that new technology could disrupt the market. And like Simon said, like if you look at the amount of money that is pouring into these things, and we do have quite an extensive relationship with universities, with manufacturers, and yes, there's going to be a big jump in lithium-ion batteries until then. So currently we're doing about 300 gigawatts. We believe it's going to probably go about 1,000 by 2025. Until then, the lithium-ion battery is still good, solid, and is investable, so to speak. But then beyond that, like I said, we're pretty cautious. And like I said, solid state could be something that could change the game. I can't tell for now. But then we keep our eyes on these technologies as well.
I think if you just look at the recent history and the slippage of the introduction of 811 batteries and of solid state, 2 years ago we were told they were coming next year. And as we sit here today, they're still not quite there. So if that's any guide, for sure there are new technologies which will disrupt. But for the next 10 years, I think we're pretty certain.
I would say one critical thing is that particularly with regards to the future technology developments, it's probably never thought about the other way around in the what is the driver for that new technology, and it's normally the purpose for what it's aimed at and what it's trying to achieve. And you've seen automakers investing into solid state battery manufacturing, and the key variable there is that you have two factors. One is the actual lithium-ion battery cost, which has an inherent limitation because of the cost of the raw materials within it. So there's two things. Either lithium-ion battery technology needs to change to have lower costs or improved performance, or both, or something else needs to step in and replace that is cheaper to produce and less intensive from a raw material perspective. And that's what will really drive. And I think, for those indicators, it's true, you've got to look at. The problem with that is trying to sort of build that into your model and then use it for a company that wants to try and finance a project is very challenging, because people go, well, if you don't know, how do I know? That is, just a complete,
The other point I would raise is the recycling point. So once you produce this EV, you're going to have to recycle those batteries, and then kind of creates a cycle where you're a bit stuck with that technology, because you need to recover the lithium. It's a chemical. It's environmentally unfriendly. You need to find a place for the lithium, and the lithium end up being recycled into new batteries and new cars. So that also helps the prevention of the lithium battery, I believe.
Just on that, I mean, how much of future demand from, say, 2025 could be met from recycling? I don't know the numbers at all, but can lithium and these other key metals be pulled out and become part of the supply chain?
It's almost negligible by 2025.
Right.
I mean, an automobile has, historically, ICE vehicles, the lifespan's about 12 years. We think maybe electric vehicles might get recycled a bit sooner.
Will the batteries have to be changed sooner?
No, I mean, that's actually, it's an interesting point because we don't know yet, because not many of these vehicles have been out there doing enough miles for you to know. It's interesting, forgive me, I don't remember the numbers off the top of my head, but if you Google the Tesla performance, one of the interesting things they've done, I think, is that as part of the contract of buying the car, you have to be always connected, and it means that they've got data on pretty much every vehicle out there. And the ones that have done the most miles, the drop-off in performance of batteries has been astoundingly good, as in it hasn't dropped off much at all, which points to a longer lifespan. Okay, but even if we say 10 years, you're only selling 2 million units last year, you're selling 4 million units this year. So even if you get all of those turning over in 10 years' time, which is not going to happen because people keep their vehicles going longer, it's such a small part of the market. It really, you can say what your figures are, but for me, it doesn't come in for 20 years as something noticeable, even with the best will in the world and lots of investment in recycling, which, as Aline said, it's going to happen because it's going to be a government mandate. But
yeah, so we track the policy side of recycling, and the market leader in terms of policy has been China. So I think up until a year or two ago, it was the only country that had a nationwide policy as to how recycling should be done. And then quite recently, we've seen Europe also take it up seriously. And so, yeah, now that the policy conversation has started, we do believe that it would help us sort of crunch the numbers as to how much of these metals can be recycled back into the system. So the technology is also pretty quite new, just to add to that.
Yeah. And Kwasi, you look at, obviously, everything that's happening in the world. Is the environmental record of the recyclers getting better? Because for a while, the battery recycling itself was an extremely environmentally damaging activity. Have they cleaned up their act?
So one good thing about this whole EV boom, so to speak, is the fact that it's beginning to shine a lot of spotlight on these activities, the minerals, the processing, and the recycling. And as these lights keep shining, because you realize that people now affiliate these metal to the green economy, you understand? And with the green economy comes a bigger responsibility in terms of environmental behavior. So we are seeing a trend where people are taking these environmental challenges pretty serious, and it can only get better from here.
I'm going to take a little survey, right? Can everyone put their hands up if they've got at least one mobile phone at home, old phone that they've put in a drawer or a cupboard somewhere? Right, keep your hand up if you've got more than one. Keep your hand up if you've got more than three. Right, does everyone in this room, I assume, knows how valuable cobalt is? So why haven't you turned it in? So the recycling rate on mobile phones right now is less than 5%. And people in this room who are in the metals business can't even be bothered to go and recycle their phones, right? So it's a really interesting sector, but it is a terrible sector at the moment, but it's going to become bigger.
But then just to add to that, at what value? Because I remember trying to recycle my Apple phone. So they had this thing on the website where you put in the year you bought it. And at the end of the day, I looked at the amount I'm going to get. I'm like, I'm better off just keeping it as a spare phone. You understand? So there's value in cobalt.
So at the end of the day, it's going to come back to price and incentive.
Price, exactly.
So if the price gets better, but also the technology to recycle gets better, because at the moment you can't get, the best recyclers can't get much of the cobalt out, really, in my opinion. So it's not worth the time for them doing it.
And a mandate.
And also, one big driver will be policy, like
policy
I mentioned earlier. You understand? Like if the government says you have to, like it's just sort of incentivize the companies to look at ways to invest in technology, to look at ways to invest in, or to sort of come to the right price and to incentivize.
There's a difference between a 200-gram phone and a 1-ton battery out in the driveway.
Anyway.
Okay, we've had a lot of questions here. Is anyone else? We've got one down here at the front.
Thank you. I just wanted to give you, I bought my BMW i3, the first batch in the UK, nearly 6 years ago. It has had zero fault, absolutely zero. The last bill I paid in the service, in BMW service, was just £2.50. The forecast is the battery will last at least 10 years. Just all I want to say.
Good.
There you go.
Case study there.
Yep. From the BMW dealership around the corner.
That was a good promotion.
We've got a minute and a bit left. Oh, was there one more question? Yep, at the back there, Jamie.
Hi, good afternoon. Being a director of Bacanora, I found that quite an interesting panel.
Sorry, Jamie.
Thank you, Simon. But the question is to the whole panel within their own specific areas. It was interesting to talk about the supply and demand and not talk about the differentiation of lithium. And what I mean by that is whether or not the supply and the demand differentials between carbonate and hydroxide, but also probably more important is the quality of the end product, which as from what my limited understanding of metallurgy is the importance of the end product is the single most important thing for the end client. And this is more of a chemical process rather than a mining product. So I'd be interested in each of your different aspects as to how relevant you see that with regards to a supply and demand case and ultimately price.
Battery grades.
Yeah, I could probably answer that first. Yeah, I think this is the problem with trying to commoditize something like lithium. It just doesn't work. The companies that produce it are generally specialty chemical companies. And the other thing you're seeing is that there's a very much a diversification of the markets in terms of the products required. And also quite a high concentration of supply chain integration across the companies. So if you think about it, actually the market for lithium is quite consolidated, both from a downstream perspective in terms of the battery manufacturer and the upstream. So everybody has their preferred supplier or suppliers. If they're lucky, they get two, but most companies just mainly deal with one. For anybody else trying to enter that, it becomes very challenging. And that certainly puts the footing onto the incumbent producers as being having the strength in the markets, then to, of course, buy up those companies that try and fail, and then to turn it around and use that capacity to qualify it for their own customers. So certainly a lot of what's been happening, if you look at Albemarle, they toll a lot of their material in China, and the reason that is that they can qualify that material and sell it to their own customers. If those other companies tried to go out to the market and sell it directly, it would take them much longer, and they'd probably have much more trouble achieving it.
30 seconds, because we're just out of time.
Okay, so quickly, like, if you take the nickel market, for instance, so traditionally, it has been really, really vertical. Like, you have the metal producers produce the most pure metal, and then they sell it off to the chemical guys who now convert it or oxidize into nickel sulfate, and then that goes to the battery manufacturers, and then you have your batteries. But then now these lines are beginning to blur. And one complexity in there is that it's the agreement with your offtake person that determines the chemistry or the composition of your final product. Some people make their batteries in XX form, and as such, they require these sort of chemicals. So it's a bit more complex than the traditional mining where you just produce your metal and you just sell it off into the market. This time, it's your offtake partner that determines the composition of your final product. So, and by extension, that also affects the pricing, but then that's a whole new topic that we'll probably have to talk about. So yeah. I'll just leave it here. Yeah.
We could go on.
I'll just say one thing about lithium in particular, how it differs from mining investors or people who are used to investing in mining, is the lack of an end market. And by that I mean an LME. So if you are producing copper, and Will's been doing this for a long time, will recognize this, that any project has an end market. If it's selling metal, if it's selling something, because somebody will buy it and store it. With chemicals like lithium and a few other products, it's very different, and that's going to make it more difficult to finance because you have to you have to know who your customer is, rather than a copper mine or a gold mine or something like that, where you don't care who your customer is because you just know there is going to be a customer.
Okay.
So it's a big opportunity to set up a new exchange for lithium, or is it other grades or two different?
I mean, good luck, but you know, like as Jamie just pointed out, there's so many different grades and so many different types of chemical impurities. It's going to be very difficult to trade.
The LME are trying very hard.
Yeah.
And actually, this is a problem from like the topic, bringing back the topic of before from the generalist money. You need to really understand, and it makes the differentiation is, you know, a factor that is a competitive advantage, but it's also work for someone that just wants to put some easy money into electric vehicles and then suddenly has to understand all this type of lithium miners, all the same products, and where does it go? It's a bit more complex.
Okay, we're going to have to call it there, just because being respectful for our speakers later, but that was excellent coverage there, and I hope you gleaned some insights. So round of applause for our panelists, please.